Hillary Sunderland, and I'm the Chief Investment Officer of Beacon Wealth Consultants. And this is your November 2019 market update. Well, we're already heading into the last month of 2019, and so I wanted to give you a brief update on how the economy is doing, because last year at this time, the concern with investors was that we would be heading into a recession soon. So where are we right now in terms of economic growth? Well, as I talked about earlier this year, we entered the current economic expansion entered its 11th year in July of 2019. So we are now in the longest economic expansion in U.S. history. And this expansion has been a bit unique. It's been more like a healthy tortoise. It's been slow but steady. As you can see on the chart on the right here, your average GDP growth historically has been about 2.7%. In this economic expansion, the average has been 2.3%. And currently we've slowed to about 2.1%. That's the latest reading of gross domestic product. We do expect that growth will continue to slow as the effects of fiscal stimulus from the tax cuts, which boosted growth in 2018, continue to fade. But on a positive note, consumption, which accounts for about 70% of GDP, appears resilient. It has been moderating a bit, but it's still fairly resilient. And so we do expect domestic growth to continue at a slow pace. We really think that a recession, that the probability of recession in the next 12 months is less than 50%. It's probably around 30 to 40% at this point, barring any unforeseen shock to the economy. On a global basis, the global economy has slowed as well, but it has not stalled. We've had global trade tensions intensify this year, which those still remain unresolved. And we've also had political turmoil in Europe stemming from the Brexit, and that is still unresolved as well. And so you do have the slowing that we're seeing both domestically and abroad, but nothing to worry about just yet, in our opinion. In November, we had a really good month for the equity markets. Large cap stocks, as measured by the S&P 500 index, were up 3.63%. Small cap stocks were up 4.12%. International emerging markets were up 0.88%. Fixed income, as measured by the Barclays Aggregate Bond Index, that index was down 0.05%. And then commodity indices fell a bit for the month of November, down 2.56%. So a very nice month for equity markets in particular overall. And this year we have seen really tremendous returns in both equity markets and in fixed income markets, as shown on this chart. But remember that the starting point for 2019 was quite low given the market sell-off in the fourth quarter of last year. So we have had very good returns year to date, but we also entered the year at a fairly low starting point given the large drawdown in equity markets in the fourth quarter of 2018. So one of the questions I've been getting is that given how much stocks have run year to date, are stocks still cheap or expensive at this juncture? So equity markets have moved higher this year, and large cap stocks have achieved new market highs. This chart shows valuations for the S&P 500 index, and by valuations, what I really mean is how cheap is the market relative to history. If you look at the middle of this chart, you can see the 25-year average price to earnings ratio, forward price to earnings ratio, which is a valuation metric, is 16.24. As of the end of November, we are slightly above that at 17.73 times earnings, which means that we, according to that metric, we are slightly overvalued, but not extremely so relative to history. What I want you to focus in on is the top right-hand part of that chart. There are many different ways to measure how cheap or expensive the stock market is, and this gives you some different ways of measuring the markets. The forward PE I already spoke about. There's also the Shiller's price to earnings ratio, dividend yield, price to book, price to cash flow. All of those are different ways to measure whether or not the market is overvalued or undervalued relative to its history. And what you can see here is that by most metrics, it looks like the market is slightly overvalued relative to history, except for that very last metric, the earnings yield spread. And think about that as how cheap do stocks appear relative to the bond market? And that's one of the major things we've been talking about year to date, is how much bond markets have run up year to date because interest rates continue to decline. This chart shows long-term interest rates, which remain very low relative to history. This goes back to 1958, and it measures at the yield of 10-year treasuries. And the 10-year treasury is currently trading around 1.78%, which is the blue line there. So you can see that the 10-year treasury and intermediate term duration bond has a fairly low yield at this point. And if you zoom in on the gray line there, the gray line shows the real yield. What a real yield is it takes the same treasury security and then adjusts it for inflation. So real yields are negative, once again, at negative 0.54%. And so because you're getting a very low yield, both in nominal terms and in real terms meaning after you adjust for inflation, you're losing money by holding on to the security. This has really made investors continue to hunt for yield in riskier areas of the market, such as in high yield bonds and in the equity markets in general, and higher dividend paying stocks. And this has been very supportive of equity prices. So if you think back to that chart I just showed you, where stocks appear slightly overvalued relative to history, but cheap relative to bonds, this is one of the reasons why. It's because yields have come down so much that a lot of investors are putting money into equities in order to earn better returns on their investments. This is a risk that we see right now in the markets, this hunt for yield, but it's something that our investment committee talks about on a regular basis, and we will make changes to the portfolios as warranted by conditions as they change. What do we see looking ahead here? Well, despite slowing economic growth, equity markets and the economy still have some room to run. However, an older expansion and bull market call for a more disciplined approach. So given how late we are in the cycle at this point, we're maintaining smaller over and underweights relative to a normal portfolio because the risks are a bit higher given how late we are in this cycle. We are seeing a lot of opportunity in international stocks and in value stocks. Within international equities, they are cheap relative to both domestic stocks and relative to their own historical averages. And we do think the dollar will likely decline at this juncture. Additionally, value stocks are very cheap relative to history, and so we are tilting toward value in our portfolios as well. We've also been diversifying into alternative strategies, given some of the risks we see in the bond markets. That chart I just showed you of where yields are right now and the negative return that some investors are earning after taking into account inflation, that's something that we are cognizant of, and we are diversifying away from those areas of the markets as we see fit within the portfolios. For non-qualified accounts, your wealth advisor assessed your personal tax situation over the last few weeks, and we did tax loss harvesting in accounts as appropriate. So as a reminder, tax loss harvesting is a strategy we use whereby an investment that has an unrealized loss is sold, and that allows a credit against any realized gains which occurred in the portfolio. So the asset, after it's sold, is replaced with a similar asset to maintain the portfolio's overall asset allocation and expected return and risk levels. And for many investors, tax loss harvesting is the most critical tool at your disposal for reducing taxes. So for our valued clients, we've already assessed your tax situation and have done that for you. So if you have any particular questions about that, feel free to reach out to your advisor. Looking ahead, we do have some ongoing concerns. The trade situation with China continues to be an area of concern and has caused quite a bit of volatility in the first few days of December. We continue to watch developments on that front very closely. We also still have negative global bond yields, the formal impeachment inquiry against President Trump. Those also pose just some unique risks to the outlook in terms of what could happen in the next presidential election cycle. And there's also the concern about the Brexit that is still ongoing as well. So as always, we continue to monitor these concerns and we'll make changes to the portfolios as needed. We thank you for your continued confidence, and please reach out to us with any questions you may have.